There are over 10,000 mutual funds available to investors in the United States. However, of all of the mutual funds out there, there is one that stands out among all of them. The Vanguard Total Stock Market Index Fund, or more simply known as VTSAX. It is by far the largest mutual fund in the world with assets under management of over $1 trillion, and it is my personal favorite index fund. And if I can dare to say it, I personally believe it is the world's greatest index fund to grow your net worth. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. In today's video, we're going to deep dive into VTSAX, what it is and why I believe it is the one and only fund you need for your wealth building. However, before we get into specifics of VTSAX, let's talk briefly about index funds first. Because when you understand index funds, you'll also understand the benefits of a fund like VTSAX. Index funds are distinct from the average mutual fund. Most mutual funds try to pick stocks that will result in the highest investment return. Unfortunately, because there are millions of investors with the same goal, stocks that are publicly traded tend to be priced correctly, and very few actively managed mutual funds outperform the total stock market over time. Index funds don't attempt to outperform the market. They merely replicate a benchmark stock portfolio or index. And they therefore provide several clear benefits to investors. First major benefit to investing in index funds is diversification. With index funds such as VTSAX, you're able to get investment exposure to over 4,000 companies. This means that your portfolio returns are not significantly affected by the poor performance of a single company. By spreading your money across thousands of companies, your investment returns are significantly less volatile and your portfolio less risky than if you only held one stock or even 100 stocks. The second benefit to investing in index funds is simplicity. Can you imagine trying to create your own diversified portfolio of 4,000 companies? Not only do you need to identify them in the first place, you need to individually buy and sell them. Then as stock market shifts with new companies and bankruptcies, you'll need to reflect them as well with constant buying and selling. It would not only be cumbersome, but nearly impossible. But Vanguard and other investment firms offering index funds have made it incredibly easy to get the same investment returns as holding a portfolio of thousands of stocks. Through their index funds, they offer investments that give the investors exposure of holding thousands of stocks in a single investment product. Getting the benefits of diversification across thousands of stocks doesn't get any easier than buying a single index fund. The third benefit to investing in index funds is a concept called self-cleansing. It means that the fund automatically recycles bankrupt companies while at the same time retaining those that are continuously creating value for its customers. No fund manager is doing this. This is just a natural byproduct of holding an index fund of all publicly traded companies based on market capitalization. And stocks have unlimited potential to go up. Just look at a company like Apple. In the last 40 years since 1982, the stock increased in value by 230,000%. However, how many of us can honestly say that if we're looking at Apple 40 years ago, we would know it would have become the company that it is today? Not many of us. But when you hold on to a good broad market index fund, you naturally get the upside of growing companies like Apple. And on the downside, you're protected because the lowest a company can go is zero. It can't fall any further. When a company fails, it'll go bankrupt and disappear, essentially making its stock price zero. However, there are always hundreds of new companies coming in to take the reign. Companies that could also one day be the new Apple. The fourth benefit to investing in index funds is its low cost. Now, this isn't true for all index funds since I've seen index funds that charge way too much. However, in general, index funds are the lowest cost mutual funds available to investors. Index funds often charge 1/10 the cost of the fees of the typical actively managed mutual funds. This is because the primary costs of running an index fund are much simpler than for actively managed mutual funds. The fund is simply tracking an index, therefore most of the operation is automated and predictable. Vanguard Total Stock Market Index Fund has an expense ratio of 0.04%. What this means is that if you have $10,000 invested in VTSAX, you're essentially paying Vanguard $4 annually to manage this fund for you. Actively managed funds, on the other hand, have to pay expensive staff to research stocks. And often very expensive at that, given fund managers and analysts are needing to meet with company executives, spend countless hours reviewing company financials, and identify the next hot stocks for their funds. Sadly, all these beehives of activity most often lead to underperformance, making index fund the best way to invest in the market. Now let's talk specifically about Vanguard Total Stock Market Index Fund and why I personally believe even of all index funds, VTSAX is the best of them all. The first reason I think it is so great is the index that it tracks. VTSAX tracks the CRSP US Total Market Index, which aims to replicate the entire US total stock market, including large cap, mid cap, small cap, and micro cap stocks. Everyone's probably heard of the Dow Jones Industrial Average or the S&P 500. However, the CRSP US Total Market Index isn't as widely known. However, this unknown index actually represents more stocks than the Dow Jones and the S&P 500, and it is probably the best reflection of the entire US stock market at a single point in time. Let's discuss the CRSP index briefly. It was designed by the Center for Research in Security Prices, or CRSP, a subsidiary of the University of Chicago Business School. One reason CRSP index is relatively unknown among the general public is that it was built at Vanguard's request only a decade ago from a monthly research tool for academics into its current form as an investable index. Because the CRSP index consists of more than 4,000 stocks, including everything from tiny stocks to blue chip giants, it shows how the entire market is doing. By comparison, the Dow Jones Industrial Average tracks just 30 big name stocks, and the S&P 500 follows the performance of 500 largest companies. Now, there are other total market indexes in the market. The other popular ones being the Dow Jones US Total Stock Market Index or the MSCI US Broad Market Index. Fidelity Total Market Index Fund, the FSKAX, and Schwab Total Stock Market Index Fund, the SWTSAX, both tracks the Dow Jones US Total Stock Market Index. However, Dow Jones US Total Market Index represents top 95% of the US total stock market based on market capitalization, whereas CRSP US Total Market Index represents approximately 100% of the investable US stock market. With that said, I'll be honest, the difference between all these total market indexes are actually quite minimal. Because of market cap, the actual difference between CRSP US Total Market Index and Dow Jones US Total Market Index is like splitting pennies. However, from a psychological perspective, I still like the idea of being invested with an index that is the most broad representation of the market. Which leads us to the second reason, and in my opinion, the best reason to invest with VTSAX. Vanguard's unique company structure. When Mr. Jack Bogle founded Vanguard in 1975, he set it up with a very unique structure. A structure that is so different that it continues to remain unique in the investment world today. Vanguard is by design, client-owned, and operated at cost. This means that when you choose to purchase a fund from Vanguard, you not only are its customer, you're also its owner. Most of their investment companies are set up very differently. They're structured to serve two separate masters, the company owners and the investors in their fund, their customers. Fidelity, for example, is a private company owned by the founding Johnson family, employees, and ex-employees. Fidelity exists to provide quality service to its investors. However, it must also provide healthy profits for its owners, the Johnson family, Fidelity employees, and its ex-employees. If there's a tension between the two groups because the market isn't doing so well and profits are low, who do you think will pay the cost to raise profits? Charles Schwab is a publicly traded company, so it's owned by individuals who own its stocks. Similarly, individuals who own stocks expect good returns on their investment. Charles Schwab needs to provide quality service to his customers to keep them happy, but at the end of the day, if the pressure is on to raise profit, who do you think will pay the cost? A publicly traded company is pressured to generate profit, and it most often will do that at the expense of its customers. It's the same story with BlackRock, the world's largest asset managers with $10 trillion assets under management. A major public company with shareholders as its owners. And the same with State Street, the world's fourth largest asset manager with $3.6 trillion in assets under management. This is where Vanguard is very unique in the investment world. Mr. Jack Bogle shifted the ownership of Vanguard to the mutual funds it operates. And since the investors own those funds through the ownership of shares within them, the investors, you and I, in effect own Vanguard when we invest with them. And because the company is client-owned, it would only make sense that Vanguard operates its fund at cost. The minimum fees needed to cover the cost of operations of the funds, nothing more. Vanguard is inherently structured to provide the lowest possible fees to its customers because they're also its owners. Your interest as the investor and the interest of Vanguard are exactly the same. What I find most fascinating about this notion is how Mr. Jack Bogle has financially benefited from this arrangement. Yes, Vanguard's consistent growth as a company the last 5 decades have produced riches for Mr. Jack Bogle, but not to the extent that other ownership structures might have done. For example, Edward C. Johnson III, the former chairman of Fidelity Investments, had a net worth of $8.2 billion at the time of his death in 2021. Mr. Bogle's net worth, on the other hand, was generally estimated at $80 million at the time of his death in 2019. Both heads of major investment firms, but vastly different net worth at the time of their death. I like to believe that Mr. Jack Bogle's lower net worth has to do with the fact that his focus was more on generating money for his customers than his own pocket. Though I admit, $80 million is not a small pocket change. Alright, with that said, let's cover some commonly asked questions regarding VTSAX. What is the difference between VTSAX and VFIAX, the Vanguard 500 Index Fund? The original index fund introduced in 1975. Compared to VTSAX, VFIAX tracks the S&P 500, representing the 500 largest publicly traded companies in the US. However, VTSAX and VFIAX are actually quite similar. The S&P 500 and the total stock market index has a very high correlation. Long-term correlation of 99% between the two of them. This is because around 80% of the total stock market index contains large cap stocks such as those in the S&P 500. While both options are excellent index funds, VTSAX with exposure to mid-cap and small-cap stocks is slightly more diversified than the large-cap heavy VFIAX. VFIAX is Vanguard's oldest fund, and because the S&P 500 remains the standard to which professional mutual fund managers and investment firms compare their returns against, many people still prefer VFIAX versus VTSAX as their core equities holding. If you'd like to learn more about VFIAX specifically, check out my video here where I go deeper. The next most common question I get regarding VTSAX is how about VTI? How does it compare to VTSAX? There are essentially two ways to purchase a total stock market index fund at Vanguard. One through the index fund, the VTSAX, and the other through its ETF equivalent, the VTI. VTSAX is Vanguard's Admiral share class for the total stock market. The Admiral share has an expense ratio of 0.04% and a minimum investment of $3,000. If you don't have $3,000 to invest in the Admiral shares, then you can invest in the Vanguard Total Stock Market ETF, VTI. It not only doesn't require a minimum, but it has a slightly lower expense ratio of 0.03%. I won't go into all the details of an ETF in this video, but the main difference between an ETF and an index fund is that ETFs can be traded during the day, and index funds can only be traded at the set price point at the end of the trading day. Now, I personally believe that if you're a buy and hold investor, you don't need to bother with an ETF, but honestly, you can't go wrong with either. Alright, another common question I get is, what if I can't buy VTSAX? Or you want to stay with other investment firms like Fidelity or Charles Schwab because you've been doing business with them for many years. What are your options? VTSAX is the best option for total stock market index investing at Vanguard, but there may be fees associated with buying Vanguard mutual funds at other brokerages such as Fidelity or Charles Schwab. So let me share with you some excellent alternatives at these investment firms. If you're invested with Fidelity, you actually have two options. The Fidelity Total Stock Market Index Fund, FSKAX, and Fidelity Zero Total Stock Market Index Fund, FZROX. FSKAX has been around much longer and has very similar returns to VTSAX. It also has slightly lower expense ratio than VTSAX at 0.015% and tracks the Dow Jones US Total Stock Market Index. FZROX is a new kid on the block and made big news when they offered the first mutual fund with 0.0% expense ratio. Few caveats to note regarding FZROX is that it follows Fidelity's in-house proprietary total stock market index, and it is only available to Fidelity customers. It also has some limitations with portability, meaning transfer to other investment firms. But if you're a lifelong Fidelity customer, this shouldn't be a problem. If you're invested with Charles Schwab, Schwab Total Stock Market Index Fund, also known as SWTSAX, is your best option. It has a low expense ratio of 0.03% that is very competitive to Vanguard's VTSAX and is most appropriate for Schwab investors looking for a total stock market index option for their retirement accounts. Vanguard Total Stock Market Index Fund is the largest index fund in the world, and I personally believe the greatest, if I can use that term. It is one of the most well-run index funds in the world and has provided millions, if not tens of millions of investors with simple, low-cost diversification to the entire US stock market. I personally believe all investors should use it as the centerpiece for their portfolio to grow their wealth. Thank you guys for watching. If you'd like to learn more about other Vanguard funds to buy and hold forever, please check out my video here. Until next time, all the best.